What's up, everyone? It's Caddy with Money Investing, and we just made a huge U-turn when it comes to the Federal Reserve's balance sheet. So, yeah, that was also supposed to come out today, Thursday, March 16th. A lot of people didn't notice that because it was at the very bottom of the Econ Days calendar at 4:30 p.m. Eastern, right after the markets closed. And the numbers were not that great because of the Silicon Valley Bank's crisis and, of course, the banks falling out. They had to kind of lend out that facility available, make it available liquidity wise to all the other reserve banks, which eventually might get back into the system when it comes to lending. But this right here were the numbers. And right now, total assets week over week expected to increase, or the prior number was 2.6 billion. We increased that to 297 billion dollars, and the Reserve Bank credit week over week was up 142 billion dollars as well. So if you come over and take a look at the total assets, we were coming down from like April and May, and this right here, around that level from 8.99 trillion dollars. You see that little spike right here, that bump? We are moving back up. This is wild. This is a very clear sign of quantitative easing once again in the market. Now, a lot of folks that I've heard are saying this is not going to be inflationary. I don't know how that's possible if the banks actually start lending money out once again. Well, some of them might retain this capital back in the bank to maintain those capital ratios and kind of improve their balance sheet, improve those capital ratios. But if this money starts to get lent out once again in the economy at the reasonable rates, we're once again looking at a environment where there is lots of lending activity, lots of spending activity, which can once again be very inflationary in nature. So this is the big spike here. You can see that we were coming down from April. Consistently, the balance sheet was getting rolled over. I'll go over the specifics here. But this right here, March 16th, from March 8th to March 16th, March 15th to be precise, a huge jump of about $297 billion. So if you come over to the balance sheet here, you'll notice that the bank credit went from $8.4 trillion, a little under $8.45 trillion, to 8.6. So that week over week change, $142 billion, even though the US Treasuries were rolled over a little bit, just a smudge, from $7.947 trillion, we came down to 7.94. If you take a look at US Treasuries, right, Treasury securities, which is the T-bills and the bonds and everything else that the Federal Reserve owns, that went down from 5.33 down to 5.328, and the mortgage-backed securities, the MBS. So those two things make up the bulk of their balance sheet, right? So if you come down to the mortgage-backed securities over here, the MBS, it went down from 2.609 down to 2.608. So a little bit of a pullback week over week, but the big change happened in loans, right? So primary credit, making it available to again, several banks. We don't know if it's one bank or two bank, but 80 billion and $57 billion in other credit extensions available to all the banking institutions, $140 billion. I've actually done some math here. Got my spreadsheet. Again, this is the Fed's balance sheet. And what we have over here is the U.S. Treasuries, mortgage-backed securities held outright, and total assets from about May 2022, so call it April and May peak, up until right now, the most recent report, March 2023. So what you'll notice is that U.S. Treasuries back in April, May were $5.7 trillion. And we have now come down to $5.328 trillion. That's the same number that we have over here. $5.328 trillion. And you'll notice that we are at this number. And the reduction, how much the Federal Reserve has rolled over their U.S. Treasuries, is at $436 billion in the last 10 months or so, whatever that is, from May to March, because June is pretty much when they mentioned they will start the rolling off process, tapering, in other words. And when it comes to mortgage-backed securities, so MBS, they've gone from $2.7 trillion down to 2.6. Again, we don't have a lot of maturities in mortgage-backed securities. So if you come down, take a look at some of the assets when they're maturing. Mortgage-backed securities, as I mentioned earlier in my previous videos, we don't have a lot of MBS holdings maturing until 1 year later, right? 1 to 5 years. We've got a little under $8 billion, then $47 billion, then $2.5 trillion. Most of them is over 10 years, right? So these are long duration bonds. That's one of the reasons why Silicon Valley Bank failed, is because they borrowed short and lent long, right? Or invested long, I should say. So that's why that's not a big change, only $131 billion getting rolled over. Then the securities held outright dropped by $659 billion, right? So that's the securities held outright, securities, right? So these are mortgage-backed securities and US Treasuries. This does not include their total assets though. Like total assets will also include securities and the loans that they have to other banks, right? So again, total assets includes both of them. Okay, securities held outright has gone down $659 billion since June, since they started rolling over the U.S. Treasuries and the mortgage-backed securities. But total assets have only gone down by $362 billion after today's report, because we were at just a little bit shy of $9 trillion, and right now we have moved up to 8.6 trillion, right? So once again, if you come back up, we've gone up for the total assets or reserve bank credit from 8.4 to 8.603. As of March 15. So that's the number that I've plugged in, 8.603. And that number has gone up $362 billion, and $296 billion is just the difference between these two numbers. That's how much it's increased by. Now, if you take a look at some of the estimates here, so June 47.5, July 47.5, August 47.5. In other words, these were the 3 months they were going to do $47.5 billion, and then increase that to $95 billion every single month in the following months. And I've actually included March 2023 over here. So far, they should have, this is the number they should have. The Fed should have rolled this amount over, meaning that the securities would have been matured and they would have rolled these over or reduced their balance sheet by about $807.5 billion. But instead, the securities held outright was reduced by $659 billion. So we are behind by a good $148 billion right now. If you take a look at total assets though, we pretty much are at $296 billion. So we are behind by $511 billion, because this is the only amount that we have reduced since April and May, right? So if you compare this amount, we've only reduced it by $296 billion. So as a result, we are behind by about $500 billion. In other words, we are behind schedule. That's what I'm trying to get at. And the reason is because we got a huge spike in total assets once again, even though securities held outright, I want to be very clear, mortgage-backed securities and US Treasuries are coming down, but total assets in one single week spiking back up to $8.6 trillion from 8.3. So we are, we're now closer to 8.9 than we are to 8. It's crazy. Like we're once again closer to $9 trillion in the Fed's balance sheet than we are closer to 8 trillion. It's like we're moving in the wrong direction, folks. What are we even doing here? And again, there's been a lot of consideration that this is not going to be inflationary. It's possible that this may not be inflationary if the reserve amount is not lent out to other businesses and individuals from those banks. But again, we got to keep a close eye on the Fed's balance sheet, because if this starts to once again go back up, this is the Fed, in a way, injecting liquidity in the economy once again. It may not be doing it in terms of securities. It's doing it in terms of lending, right? There's not much of a difference. Yeah, sure. I mean, lending, you're making some interest rates and the banks actually need that, right? But we got to keep a close eye on what ends up happening here because of inflation pressures. So hope you guys enjoyed this video and found it helpful. A little bit of an update on the Fed's balance sheet. Again, I'll leave some resources available in the Discord if you are interested in kind of going through this yourself. But let me know your comments down in the comment section below. And do you believe if it's going to be inflationary or deflationary? Let me know in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Happy investing, and I'll see you all in the next video.